The introduction of IFRS 15, revenue from contracts with customers, has brought a significant shift in revenue recognition practices across various industries, with the telecom sector experiencing some of the most notable impacts. Given the complexity of telecom offerings, often involving bundled services like mobile devices, data, voice, and subscription plans, IFRS 15 requires telecom operators to re-evaluate how and when they recognize revenue. The standard emphasizes a contract-based, five-step model that necessitates allocating transaction prices to each distinct performance obligation, potentially altering the timing and pattern of revenue recognition. This change not only affects financial statements but also influences key performance indicators, contract structuring, and system processes within telecom companies. As a result, IFRS 15 has become a catalyst for financial and operational transformation in the sector. Welcome to the Chartered Accountant's Pen. Today, I'll be presenting on the impact of IFRS 15 on the telecom sector. This standard has reshaped the way telecom companies recognize revenue and manage contracts. We'll walk through the principles, the practical implications, and how telecom businesses are adapting. IFRS 15 was introduced to bring consistency across industries in how companies recognize revenue. It replaces older standards like IAS 18 and IAS 11. The key innovation here is the five-step model, which aligns revenue recognition more closely with the delivery of goods or services. The standard took effect globally from January 1, 2018. Telecom companies often sell bundled products, like a handset, data, and calling plan, all under one contract. Under previous standards, there wasn't a clear method for handling these bundles. IFRS 15 requires each element to be separated and accounted for individually. This has a big impact on when and how revenue is recognized. This slide shows the core of IFRS 15. Step 1 is identifying the contract. Step 2 is identifying all the distinct deliverables, called performance obligations. Step 3 is figuring out the total transaction price. Step 4 is allocating that price to each performance obligation. And finally, Step 5 is recognizing revenue when those obligations are fulfilled. Under IFRS 15, telecom companies might recognize more revenue up front. For instance, if a phone is sold for free or at a discount with a monthly plan, part of the monthly payment is now reallocated to the handset. This means a portion of revenue is recognized immediately, not evenly over the contract term. It reflects the actual economic value delivered. Implementing IFRS 15 isn't just a finance task. IT systems must be updated to support more granular data. Contracts need to be unbundled and evaluated, which isn't always straightforward. Companies also need to make estimates, like expected contract term or standalone selling prices, and those estimates must be consistent and auditable. Changes in revenue timing affect key financial indicators like EBITDA and average revenue per user, or ARPU. There may also be changes in how telecoms design contracts to remain profitable under the new standard. IFRS 15 also increases disclosure requirements, pushing companies to be more transparent about how they earn revenue. Let's consider a practical example. A customer signs up for a $0 upfront phone with a $50 per month plan for 2 years. Under IFRS 15, we must separate the handset and the service. If the handset has a fair value of $500, a portion of the contract price is allocated to it and recognized at contract start. The rest is recognized over the 24-month service period. Now, let's look at the accounting entries. At the start of the contract, in month 1, we record the following. Debit the contract asset for the full contract value of $1,200. Credit revenue for the handset, since the phone is delivered immediately, for $500. Credit revenue for 1 month of service. That's $29.17. The remaining amount which is $670.83, is credited to unearned revenue. This is deferred revenue for the service to be delivered over the remaining 23 months. Now, for each of the following months, from month 2 to month 24, we do the same entry repeatedly. Debit unearned revenue by $29.17, and credit service revenue by the same amount. This approach ensures that revenue is recognized based on performance obligations, the handset up front, and the service over time. While the transition was challenging, IFRS 15 has brought clear benefits. It forces companies to better understand their contracts and customer relationships. Reporting becomes more accurate and comparable across the industry, and ultimately, it helps build investor trust by showing the true economic activity behind revenue. To wrap up, IFRS 15 has driven a transformative change in the telecom sector. From accounting practices to system upgrades and strategic planning, its impact is broad. The key to success is collaboration between finance, IT, legal, and operations to make sure contracts are structured, tracked, and reported correctly. To see more videos, please don't forget to subscribe and hit the bell icon. Until next video, this is Chartered Accountant's Pen.